So we're going to start off with a quick kind of presentation from Kevin here, Kevin Turpin, who's Regional Director of Capital Markets for CEE for Colliers. So Kevin, over to you, just to give us some insights on what you're seeing in the market at the moment.
Great, thank you. Thanks everybody for attending this morning. And yeah, like I said, I'll just give a short overview of what's been happening in the markets recently, where we see things going or moving, and hopefully that will set the scene for the panel discussion that we'll have that follows. So just a very quick introduction. So Colliers, I'm sure you're very much aware of. What you may not be aware of, in Central Europe we have a team of over 35, including my colleague Dorota sitting here, and who will be on the panel later, doing corporate finance and living services. So we're across the main, all the main markets, and we're sort of tracking those and helping clients in all of those markets. So today is a very complicated. We're in a very complicated world. There are so many things going on at the moment, which is causing decision making or making decision making very difficult. And in fact, a client of mine said to me the other day, in a normal world, I would have 30 things that I need to sort of deal with, and 25 of those will be kind of a sort of fairly routine and sort of tick box, and 5 of those, would need a lot more sort of in-depth study and work around those. And today it's completely the opposite. So he's literally got 5 things that he can tick box, and then 25 things that cause a lot of problems. And some of those are here on that board, or on the screen today. COVID-19, it's not over yet. Certainly, we're in a better shape, better place than we were over the last couple of years. And that's led on to numerous things like supply chain disruption. Again, a lot of problems in the financial markets through quantitative easing. There's been endless amounts of capital being raised to go into real estate. Later on, we've got the war in Ukraine, which is obviously causing a number of problems from, again, in the supply chain, but also in food, energies. We all know that, we all can see that coming, and a lot of those factors are still yet to play out. And this is, of course, having a huge impact on inflation, which has led to rapidly rising interest rates, and we'll cover that off in a minute, and how that's going to impact on the pricing of real estate. Then we've obviously got climate change. COP27 is on right now, and to some extent this has been put a little bit on the back burner because we've got multiple other things to worry about in our decision making, but we still need to factor that in. We still need to price a lot of that in, which may not have been done yet. We've also got quite strong employment figures at the moment. So almost up until this point, almost anybody that wanted a job could almost get one. But that's also leading to quite large wage inflation, and again adding to that, adding to the issues that we have for our occupiers. So very quick macroeconomic snapshot. So for the CEE markets, which the ones that we sort of focus on are Poland, Czech Republic, Hungary, Slovakia, Romania, and Bulgaria. I think obviously the main elephant in the room is obviously that inflation, which in most countries is at or around or above the 15% mark. The further you further east, northeast you go into the Baltics, they are even higher. But then you also see, if you also look at the central bank rates, so you sort of get a bit freaked out when the ECB puts their rates up, by 25 bips or 50 bips. Czech Republic 7%, Hungary 13%. So of course this has a massive effect on mortgage rates in these markets, with the exception being rather Slovakia, which is the only country of these which is euro denominated. The economy. So generally speaking, these are relatively small economies and fairly nimble, and have performed generally quite well. But that doesn't necessarily mean that they can survive everything. Poland was the only country that didn't go into a recession during the global financial crisis. It's maybe, most of these countries are not in as good shape following COVID as they were back then, and it's likely that we will see some recession coming through. So it's difficult to sum up, leasing markets in a short time, but I'll just try and tackle this in a couple of slides for the office market and for the industrial sector. If we look at occupier trends or occupier sort of balance between landlords and tenants. So the office market, thanks to COVID, obviously it's been quite a seismic shift in the way that we all work. We all know that. We've all talked about it for at length and what it's going to look like in future. But the simple fact is that many companies are sort of questioning what they're going to do with their space, and this has led to higher vacancies in many markets and across our region in Central Europe. Some of those vacancy rates will range somewhere between sort of high single digits, moving out towards sort of mid-teens. So supply is definitely slowed, and as I said, we will see the office markets coming more from a tenants market more into a balanced market over the next 24 months, we believe, which is the opposite for industrial and logistics. So of course it's been the darling topic of throughout COVID and has gone from strength to strength through changing structure in how we shop and so on and so forth. So it's so on the contrary to offices, industrial logistics is very, very much a landlord's market, but it's not without challenges, and we'll hear from Dirk later on probably about some of the challenges they are facing. Yes, there's high demand, but costs have gone up, there's land scarcity and so on. So it's delivering the product, it can be quite challenging, and across our region in Central Europe, vacancy is well below 5%, and I think Czech Republic is even below 1%. So it's quite challenging to get hold of that. And I said, what you'll see from that, and what we have seen, particularly on the industrial side, we've seen quite strong rental growth. So whilst we will, and we'll talk about yields in a minute, whilst we will see yields moving out, we are seeing some compensation from that through rental growth. We will also see that in certain select office markets as well, particularly as the cost of delivering space is again much higher today. So again, looking at volumes on the investment markets, 2007, followed by the global financial crisis, big steep drop in activity, and then basically what we've seen 10 plus years of unstoppable growth in the region. Just to put Central Europe into context, Central Europe in a very good year is somewhere between 10-12 billion. That's 10% of a typical year's volume in Germany, and similar to a market the size of Denmark or Sweden. So we're not talking about a huge market, but again, it's still a significant amount of money. So we had this long stretch of growth. Everyone pouring more and more money into real estate for very good reasons, which we'll come on to. Then we have COVID. Obviously, there was a drop-off, which in actual fact is not that bad, considering that much fewer retail and hospitality assets were selling, which are usually typically sort of quite large ticket. So a 20% drop-off, considering that there was less of that happening, is not terrible. For this year to date, we're about 7.5 billion for the year. Definitely quarter one was very, very, very robust. You could argue some of that was tailing over from pent-up demand from COVID, but we are seeing a slowdown through Q2 through Q3, and that's a similar trend that we're seeing in other parts of Europe as well. So what are people buying? The most active sectors typically have been offices, followed by retail, and retail, particularly in the last two and a half years, has been supported by retail parks, supermarket chains selling out, and industrial, of course. Now, industrial would be considerably higher if it was not for the fact that the majority of developer investors in the region are long-term holders. And I would say that's, you could argue that's probably somewhere between almost 60%, 60-70% of the entire Central Europe is in the hands of your long-term holders. Residential, so whether that be, we group that in and call it student housing and other types of housing in that sense, but the PRS market. So this is, again, a hot topic. We'll talk about it a bit later. But really, at the moment, it's really only sort of taken off to some degree in Czech Republic and is growing at quite a pace in Poland. So there's a big chunk in Czech Republic, which is a very large portfolio that Blackstone acquired through their partner Roundhill, was then sold to Heimstaden, and it's traded a couple of times. So that's why, in a short space of time, so that's why that's so large. And we'll talk again maybe also later on about the reasons why PRS is perhaps a good asset class to look at when we come to the panel. So again, the other thing I should mention, typically Poland, being the much larger market in the region, is responsible for about 50% of all activity in investment volumes across the region on a good year. This year so far, it's nearly 60%. So we've seen bigger market, more opportunities there. So where does the money come from? Now, typically, so it's very different, and I think we will share this slides if you're interested later on. It differs per market. So you've got a market like Poland, which is heavily dependent on international capital. Only 2% of let's say funds there because they don't have the, let's say, legislational structure for domestic money to buy, as opposed to Czech Republic and Hungary, where that's more prevalent. And there are multiple sort of qualified funds in those markets that are able to invest in their own markets, which is on the left-hand side, and then collectively on the right-hand side you've got all CEE capital, which is mainly Czech, Hungarian, and a little bit of Slovakian, investing in other markets in the region. So just to put a sort of couple of numbers on that, so Hungarian money investing in Hungary this year is 80%. Czech money investing in Czech Republic is around 50%. And then I think Central European capital investing into Poland this year has been around just a little over 10%. So domestic buyers are becoming equally important, particularly in times like this when when a number of investors are having a sort of a hold period whilst they're waiting to see how pricing shifts or moves. So, talking about pricing, and I think this could be my last slide. We've hit a phase where interest rates have gone up for the reasons that that we talked about earlier, and the ECB key interest rate now is 2%. When you add on a swap, obviously you're not doing that on the whole volume, but still you're still somewhere close to 5%. So all-in costs could be somewhere around 6%. So when you follow that orange bar across, you can see that quite a number of these markets are still below. So there is still some scope for pricing discovery there, because if prime yields even in Germany, sort of blend of the main markets there are sub 4, it doesn't really stack up. So we've seen in Western European markets, which tend to move a little bit quicker, we've seen some of those move by anywhere from 50 to 100 basis points. In Czech, Poland, we've had a lack of evidence to sort of be more concrete, but we've also moved those by around 50 basis points. But we believe and we can expect perhaps more to come. again, just very, very broadly, general consensus from people I've spoken to, from our competitors and clients we've spoken to, that that shift could be in terms of capital values, could be anywhere from 15 to 30%, depending on the sector, on your building, of course, lots of variables. But this is something we can also discuss, from sectors to location and types of products that are available. So yes, there is that, and then of course the other factor is real estate yield versus bonds, which are again is also a very much a narrowed margin between those and other investment strategies. So a very interesting time ahead for the next 6 to 18 months, we believe, and we'll look forward to discussing more on that in a few moments.
Great, thanks very much, Kevin. Super, thank you. Perfect. Thanks very much, Kevin. Lots to pick up there, I think, in the panel. So if the speakers could just join us, that would be great. As you join us, you will note that there's a little button on the top of that, and as you slide it across, like I've just done there for you, Dorota, then it turns green rather than orange. That's the perfect. So really interesting to get that focus, I think, just in terms of some of the content that we've got there, some of the investment topics that we can pick up in the panel. We've got a lot of expertise on the panel here. We're not going to do it as a sort of Q&A. It's going to be much more of a sort of round table approach. So feel free to come in. Let's make it an open conversation. Let's share some views. And you're sharing one approximately between two of you, so just if you manage that would be great. And let's just start with introductions. For those who don't know me, I forgot to introduce myself at the beginning. My name's Richard Betts. I'm the group publisher at Real Asset Media, and through Real Asset Live, which is our events and TV side, we run around 80 events a year, and we also publish the Real Asset Day, which is a daily newsletter, Expo Day at Expo Real, and also Real Asset Insight, which is a general market focused publication, Real Asset Impact, which focuses on ESG and social impact, so interesting especially that we've got COP27 at the moment, and Living Retail, which is in the mixed use and retail side, for MAPIC, which comes up later on. Let's start with introductions. Dorota, let's start with you and then we'll move along.
All right, thank you. Thank you, Richard. So my name is Dorota Wysokińska. I'm heading the corporate finance and living services. I'm based
I think, Dorota, we're going to start that again. We're going to unclip that, and if you hold it near you, then you can pass it over to Simon as well, and I think everybody will be able to hear you better online.
Now I hear myself better. Okay. Here we go. Okay. So once again, my name is Dorota Wysokińska. I'm heading the corporate finance and living services business line at Colliers. I'm based in Warsaw, responsible for CEE. Basically, I don't know. It's working. Yep. What we do for clients, any type of help in different equity structures, debt structures, all around living services, which is actually a very hot topic nowadays, especially in Poland, but also happy to discuss this later on.
Great, perfect, Simon.
Simon Wallace. I'm the global head of research at DWS. DWS is a global asset manager based out of Germany. We have approximately 65 billion euros of assets under management, around half of which are in Europe. In the CEE, we're based out of Warsaw. For us, the CEE is very much Poland, Czech, and Hungary at the moment, but we're certainly keeping the other markets on our radar. Within particularly Poland, very much focused on the office market, but also logistics and retail as well.
Great, Justyna.
I'm Justyna Kędzierska. I'm heading the Warsaw office of Berlin Hyp. Berlin Hyp is one of the leading German real estate lenders with a strong focus on sustainability, both at the company level as well as in our financing activities. Germany is, of course, the domestic and the main market for Berlin Hyp. However, we are also active abroad, and Warsaw office is one of our 3 offices. From Warsaw, we are also covering Czech market. Thank you.
Perfect. Dirk.
Mini microphone.
Mini microphone, exactly, yeah.
Good morning, everybody. I'm Dirk, and I work now for already a month at CTP. CTP is a pan-European investor and a long-term investor and holder of and developer of, let's say, industrial and logistics real estate. Originally, we started in Central Eastern Europe. We are active in 7 countries in Central Eastern Europe. Big parks, a lot of big value-add logistics facilities. So 7 countries in CEE, 3 countries, let's say, in the more western part of Europe. But overall, you really see a lot of activity in Central Eastern Europe and a lot of different dynamics we're going to talk about today.
Okay, perfect. Lukáš.
My name is Lukáš. I'm a partner with CMS. CMS is a large international law firm, 5th largest in the world, actually. We have the largest team in Europe for real estate. And as Mark mentioned earlier, we've been in CEE since the 1990. And we have very large coverage geographically in CEE, the largest probably. And we serve the institutional private equity clients, lenders, borrowers for all real estate services.
Perfect. Robert.
Good morning. Robert Martin. I'm the partner and head of investment at Europa Capital. We're a pan-European investment manager, and we have been investing in Central Europe for 25 years, and so we have seen some ups and downs there.
Perfect. Carolis.
Hi, good morning. My name is Carolis Hadlis. I'm part of WP Carey, Executive Director in London. WP Carey is the American REIT focusing on long-income investments. Still is because our bread and butter. We buy mission-critical, single-let commercial real estate, been in Europe for over 20 years, and like the region, I want to do more here.
Perfect. Thanks very much. So really good, interesting spread of different views, different perspectives that I think we can bring, both in terms of insights directly from the region, but also those investing in it from here in international capital. And of course, if anybody's got any questions in the room or any thoughts, feel free to somehow let me know that you want to speak, and I will make sure that you do, and we can share those comments. And also online, feel free to put a question in the Q&A, and we'll try to make sure we pick that up for you. It would be interesting, I think, maybe, Robert, let's just start with you. I mean, Kevin mentioned about international capital. You're representing, international capital to a certain degree there. I suppose, what are your thoughts on that? How do you see the region, and also how do you see it, I guess, in the context of the other areas where you are investing at the moment?
Yeah, so you may remember, Richard, back in April, I was on a panel which you moderated, and one of the other speakers was talking about we were at a tipping point in the market back in April, and I think the market has definitely tipped. And we know where we're going. And I said at the time that I thought it was a good time as an investor just to sit back and see what happens. And we've done that for the last 6 months. I think that, in my 25 years of doing this job, what part of it has been trying to persuade investors that Central Europe is a good place to invest. And there's always comes back to 3 sort of key things. One is political and geopolitical risk. Second is liquidity, and the third is that it's got a stable legal system. So if you break all the questions down, those are basically what they come back to. And frankly, it's the first one is not good at the moment, right? I mean, there is a big geopolitical problem there, and that's scaring a lot of investors away just because of the perceived risk of what that may do to the region. It doesn't actually have any effect. It may not have any effect on the real estate market as such in terms of the fundamentals, but the perception of risk caused by the war in Ukraine is huge on investor sentiment in Central Europe. And so we have to take that on face value. And it's quite a difficult sell, frankly. I think with liquidity, over the last 25 years, the liquidity in the market has improved so much. Since the last financial crisis, as Kevin was saying earlier, there's now 30% of the deals are done locally. I mean, that's huge. I mean, back in the last financial crisis, there wasn't that local money. So it was very, nothing happened for months, for years in the global financial crisis. So I think that in terms of how I see Central Europe compared to the rest of Europe, I think it's quite a difficult sell at the moment, and frankly, is it worth it? It's a tiny, again, as Kevin said, it's a tiny part of Europe, and there are some easier sells out there if you've got to go and tell investors why you're investing now.
Can I have a question to that?
Yeah.
It was on my mind. The perception of the international investors, the Central Europe being a risky region because of the war. How well, you know CEE very well. How much riskier is it that the war will spread to CEE than to sort of Western Europe? Is there a real risk at this moment? I could understand it at the beginning of the war, but now when you see how the war has developed, is there a real risk?
I think, as I said, it's a perception, right? So it's perceptions of risk, and investor sentiment is all about perception. And I mean, I'm sure there's some other people on the panel that can help me answer this question. But to me, when I go and speak to investors about Central Europe, they immediately go, "Nah, why?" I mean, there's a political, it's just close to it, right? Just the physicality of being close to it. So I just think it's and they think there's easier things to do. Yeah.
I'd agree with both of you on that point, to be fair. From a pure research fundamentals perspective, I look at Warsaw, for example, and what I was hearing around in Warsaw, that even the office market was doing pretty damn well. Following the start of the war, you were seeing relocations into that market. We were getting huge amount of sort of bids on vacant space that we had in that market. But I was in Singapore, I was in Australia the last few weeks, and I go into sit down in Singapore and say, look, we've got a strong call on the Warsaw office market. They smile and they nod politely, and that's what I get at the moment. So I agree, it's a really hard sell at the moment. You need an investor who's, they'll see it as taking a punt. And it's an investor that doesn't necessarily need to go up to their investment committee and try and convince as well. Because remember, you're talking to one person, but they're talking to many other people as well who don't have that local knowledge, that understanding of the market. So I think particularly that sort of in international capital that is far away, very, very difficult sell. Perhaps European money, German money at the moment would be more willing to consider the CEE markets. They've got experience there in Warsaw and other big cities in the CEE. I think that's probably easier ground, but overall it is difficult. But I think that's important, because if it is difficult, that's where opportunities will arise, because there's likelihood of mispricing in the market. And I think, Kevin, you were talking about price discovery in this market. Look, I think where we are, what we're showing, where the yields are in the CEE market, I think if you were to try and transact today, if there's a building available right now, it wouldn't transact at those yields. It would be another 50 basis points higher than what we're showing in our valuations.
Okay, good. Yeah, Carolus, go ahead. Yeah.
I'd like to give an opposing view. I think it's not necessarily true, or not for everyone. In our book, we don't see the war as a risk. I think Russia, and I'm no political analyst in any way, but I think they kind of bogged down in that war. I don't see any risk of them going beyond Ukraine. When we look at deals in CE, we price that risk to some degree into the yield, but we like the region, and I think what makes that region more attractive today than before to some degree is because of the increase in the cost of capital for a lot of investors, Western Europe, where the yields are still not reaching the point where there'd be price discovery. I think you can only achieve yields in CE to make your cost of capital work. For example, logistics building, so we're trading in sub 3%, maybe sub 4%, and now they shifted out to high 5%, right? If your cost of capital now is above 5 or 6%, CEs we can actually make that capital work. And I think it's still a very attractive region, so I would definitely not say that it's a no-go, and I think it's still very attractive, and we're seeing deals there, and we're bidding on deals there, and we try to make the money work.
And
Okay,
if I may add also exactly to this, because being advisor, we are meeting with a lot of investors, and of course during March and April, the war was the number one topic. But since approximately June, July, it's not a topic any longer. And I mean, there is a topic for some of them. So I'm not saying everybody is feeling great, but I think main issues today is general macroeconomic in Europe, not only in CE, but generally I think in especially Western Europe with high inflation across each of the country, different levels, but exceptionally high. So the highest, as I know, 30, 50 years in some countries. interest rates increasing and still no visibility where the interest rates are heading for. So talking to different investors, we are really not talking about the war. We are not really talking about the risk, because I think not only there is no real risk, but I think the perception changed a lot. So that there is no discussion about this, but this is of course a general, market sentiment because of the situation in Europe, which is causing discussion whether I go, with, I don't know, a bargain deal in UK or I do a good investment in Warsaw. And here you can argue, and here you have different views. I mean, we have investors who actually, as you already said, they would choose Warsaw because we are still very strong in demand. Actually, what is not very often said loudly, for the Polish economy, as sad as it sounds, the war is helping demography, the war is helping the internal demand, help the economy as such. I'm not saying we will be the green island. I hope we will, but I don't know, probably not. But I think in comparison to other countries, we have this strong demand coming, So you have really interesting opportunities, and I think especially also on the yield and the repricing, it will be probably easier to agree on a new price in CE, because the yield compression will be lower, because we are starting from a higher level in comparison to, say Germany with 2% and 3%, and with the financing costs at almost close. What should be the yield? I mean, you do the math, right?
And Justina, let's pick up your view as well on this, because it's interesting. It'd be interesting to get your perspective there from the financing side as well. Just in terms of any of the things that we've picked up there, but also, I guess, your view on what you're seeing in terms of capital, what sort of, I suppose investors are beginning to look at this, what you're seeing in terms of demand in a way.
We of course have also noticed the decrease in the activity in the investment market, that's for sure. But on the other hand, the market is not dead. I mean, based on the figures which you can see that there are still quite huge volumes being traded, even if they are lower than they used to be last year, or what was expected before the war started. From our perspective, of course, the current interest rates environment puts us in a new situation as well. It is clear that, of course, the maths, the figures must work in any new project which we are looking at. There is still sometimes not enough understanding on the investor side that just the financing structures, they need to be adapted to the new circumstances. It just always takes time, to get used to new world, new conditions in general. I think what will be kind of a challenge in the next months for all the lenders, maybe not all the investors, will be the refinancing of loans which are maturing in the next months. Typically those loans were structured like 5 years ago, so at a totally different with a totally different interest rate environment. So of course, as long as your structures are moderate, let's say with low leverage, there is typically enough room to have something adjusted, but I'm sure that there also will be some more problematic deals where probably also a kind of additional equity input will be needed to be able to keep the covenants in general. And maybe just one more point, what we have still not seen, and this might be a kind of an issue, again, are the values. You do not see, let's say, the valuations reflecting the current environment. And I know there's a discussion between the valuers, because of course the valuers, to be able to value, they need certain reference values. They are not there because due to the lack of transactions or not enough relevant transactions. Yes, and I hope what Kevin said will not happen. I hope we will not see such a dramatic decrease in values. On the other hand, we of course need to be prepared for such scenarios as well.
Okay, good. I wanted to get your take on it, Dirk, because obviously you've really kind of just moved into the region to a certain extent with CTP, and I know that you've been sent on a sort of mad dash around the assets across the region. So I guess what's your take on it as somebody, I suppose, you know, obviously previously in Prologis you were looking across Europe, but actually, you know, now looking at the region in more detail, perhaps.
Yeah. So to be clear, in the past I worked in the CEE region as well, but now indeed it is even more. So now 1 month at CTP, I already visited all the 10 countries where we're active in, and when you are really on the ground and when you really see the different markets, I saw a couple of trends which are applicable for all the markets in CEE and a couple of trends for logistics and industrial which are really different. So, for instance, what I really saw in the market is, in general, feeling like we are open for business. And that's something which is really, I think, typical for CEE. It is open for business when you think about the work ethics. That's what you hear a lot of from the clients in our warehouses. So, strong work ethics. It helps, of course, with the competitive labor rates. In a warehouse, you pay 1/3 versus Germany, so it is relatively more competitive. You see a lot of foreign direct investments, you see a lot of infrastructure development, so it's really, let's say, open for business. The second trend, which is a similarity between the different markets in CEE, is about supply chain resilience and the, let's say, the decoupling of the supply chains. So first we saw the higher inventory rates, now so more products being shelved. And now we see much more the nearshoring trend entering the market. CEE is well positioned due to its location. And again, because of price as well. I saw, and that's one stat I would like to share, I saw a stat where they compare the average hourly rate of a forklift operator in China versus Czech, and it's roughly the same. Poland is cheaper, more competitive versus China. So the deconsolidation of the supply chains, nearshoring, is not only driven by reliability, but it's driven by price, and I think for sure by, let's say, the greening of supply chains as well. You have the expanding economies across the globe, across CEE, the emerging middle class, and you see across all the regions the diversity of demand. So it's manufacturing, it's value-added services, it's traditional logistics. That's really something which is typical for all the markets. But there's some differences as well. E-commerce. Czech is almost like a Western European market in terms of e-commerce trends, while Bulgaria, Romania markets are really just, they are already adapted, but they are still quite early. Undersupplied markets, again, Czech, very high stock per capita. Romania really lagging. I'm not saying that Romania will have the same levels as Czech, but that's a kind of, they are catching up, those markets. Difference. Liquidity. Kevin talked about it as well. You see differences of liquidity. Some are really not that liquid, while others are, like Poland. And the last one is about market fundamentals. Big differences between market fundamentals. Again, Czech is for me almost like a Western European German markets, 0.6% market vacancy rate. Poland is really finally catching up with the decline in logistics in terms of vacancy, finally rent growth. While in the more emerging markets, you see in general higher vacancy rates, really an expanding market. So again, I think that's the bottom of my 4 similarities, 4 differences. It's a really evolving, rapidly evolving market, and I think it's one of the most diverse logistics industrial markets in Europe.
Okay, interesting. We'll drill down a little bit more into the logistics side again. But Simon, maybe just coming to you. I mean, so for example, we did a an Iberia summit here in London a couple of weeks ago, and just picking up on your point there, Robert, about perception in the market, one of the perceived advantages of the Iberian market was that it was 3,000 miles away from Ukraine. So it's interesting that they are selling themselves in a way on the complete reverse argument. But I suppose, how do you see it? You mentioned that you were in Singapore, obviously, and speaking to investors there. But how do you see it within that context? So looking at the other markets within Europe, what's your view on it?
Yeah, it is funny that I was talking to a group of Americans last night, and I was discussing the war again in Ukraine, and I was saying, well, look, guys, I'm sat here in London, and we're only 3 hours flight away from Ukraine, and that's you flying from New York to Chicago, pretty much. So let's put that in context. So, look, I think I do agree. I think that depending on the countries you go to and depending on their experience in the CEE markets, they'll have different perceptions. So if you're not experienced in the CEE markets, you will look at a country like Poland adjacent to Ukraine and you will say, it's too difficult for me to make that case. If you're well experienced, if you've got a team on the ground, particularly if you've got a team on the ground in Warsaw, I think that conversation moved on quite quickly. So when the war kicked on early this year, and unsurprisingly, we ring up the guys in Warsaw and we ask, what's going on? How are you feeling? What is the perception in the market at the moment? And they said, look, it feels like normal. It doesn't feel any different at the moment to us. And actually, we're seeing the economic benefits of this. And it seems perverse to talk about economic benefits from a war, but that was the reality on the ground, that there were economic benefits. As I say, it is a hard sell. It is a hard sell to get Poland and the CEE markets on the agenda for most non-European international banks at the moment. And look, I will continue to bang away about it, and I will continue to make the case. But sometimes one does have to care about one's own credibility. And so, if I've turned to a Singaporean investor or a US investor and said, "Come on, it's time for Warsaw. Come on, it's time for Warsaw," and they again slowly usher me out the room. Eventually, we still have a business to run, and I'm still trying to grow AUM. So, it's still an easier sell to talk about London, still talk about Spain, even talk about the German market. And I think that point about repricing is important at the moment. I think that perhaps that lack of liquidity in the market will become not an issue, but we need to see that differential in pricing at the moment. You look at the UK market today, and think about logistics in the UK market, we're probably talking 100, 150 basis points increase in UK logistics today, and your yields not that dissimilar from what I'm seeing in, say, the Polish market right now. And anecdotally, what I'm seeing in the German market is that what was priced at 3% in Leipzig, again for logistics, is now probably trading at 4 to 4.5. So I think I need to see that repricing in the CEE markets to again reinforce my point that we like this region long term.
Okay, good. And Karas, it'd be interesting just to come to you in terms of the opportunities that you mentioned that you were seeing there. Are we going to see, do you think, potentially, because we may have, we may have issues in terms of loan to value or things like that potentially. Is that going to lead to there being more kind of sale and leaseback opportunities? What are you seeing? What opportunities are you looking at?
So I heard here a word of where deals used to be and where things are trading now. I think that's a wishful thinking. I don't see things trading much today. I think there's a lot of bidding and people trying to connect the bid and ask. I don't see much trading yet. That's yet to happen. But we are seeing a lot of stuff. I think when people discuss the Russian risk, the war risk. And I was on a panel discussion, I think, beginning of the summer, and people say, what's the risk? And everyone's like highlighting war as the biggest risk. And I'm like, you forget the interest rates, and you forget the inflation. And I think for me, those are the biggest risk for the market. And I think what that's causing is, it's creating opportunities, in my view, from, deals gonna come from three sources. First of all, I think you're gonna see funds who bought stuff too expensively or were levered that is short term. They're going to have to sell some of this stuff because there are a bunch of redemptions happening. So I think there's going to be a source of deals coming from funds, not really fire selling, but because they have some refinancing coming up. And then you're going to see, I think, sales from funds who did deals over the last, 3 years ago, and they have a horizon to sell assets or liquidate some assets within, year and a half, 2 years. They're probably going to do it now rather than next year, because expectation is that next year the price is going to be worse. So we see a bit of that happening as well. And the third piece, which you asked me about sale-leaseback as well, and we're already seeing a bunch of these happening, and we've been approached by brokers about sale-leasebacks coming from these sources, is where companies, like it was mentioned before, have financings maturing in the next year, 6 months, 12 months, 18 months, and they need to refinance that money. And that money used to be sub 1%, 1.5%. Now it's going to cost them 5-6%. So they considering now a sale-leaseback as an alternative tool to financing, which is a lot more attractive today than it used to be yesterday. And there's a bunch of companies who are exploring sale-leaseback solutions to recapitalize their balance sheets, and I think there's going to be a lot of deals coming from that. I hope it's not wishful thinking. I was saying the same thing during the pandemic, which wishful thinking. So, I'm talking in my book, but that's what I hope to happen, and I think we're seeing the start of it already.
Okay, good. Lukasz, in terms of what you're seeing, are you seeing different types of strategies coming through? Investors, maybe more opportunistic investors beginning to look at the market for those kinds of opportunities if there are things that are falling out because of refinancing or, loan-to-value covenant issues?
What I see is exactly as you were talking about, and the perception of the capital. The further they are, the more risk they see. The closer they are, the more opportunities they see. So we see a lot of activity among regional investors. Czech, the Hungarians, they go and they want to invest. They cannot find opportunities in Czech and Hungary and elsewhere because the markets are, let's say, frozen, paralyzed at the moment. They can still find opportunities in Poland, and they do find them, and they know the markets quite well. They are not afraid to go to the regions, and they invest in logistics, they invest in offices, and they actively participate on the market. I think everybody is sort of looking for distress opportunities in the future. I don't see them now. I think people are, ready to jump on them when they are available, but not at the moment.
Okay, good. And I suppose, Justina, coming to you, if those opportunities are going to arrive, what are the points that people should be looking at? Is it to do with where if values change and therefore there's an issue with loan to value? Is it when refinancing comes up? What's the position of the banks, and how's that going to influence, I suppose, the investment side, and therefore whether or not these opportunities come through into the market?
Well, I guess the fundamentals must always be the same. I mean, just the cash flows must work, and yes. So this is like from the structuring point of view. Another point is, of course, this that from the market perspective, the lender's perspective as well. The ESG topic becomes more and more important, and well, I think that in CEE or specifically in Poland, the awareness of the significance of ESG and all the energy efficiency thematics is really very high. We are. Again, I see as Poland, we are in a good situation that the existing stock is really very modern compared to the Western Europe countries. From the lender's perspective, of course, sustainability will be becoming even more important. So you need to make sure that this is the right project, this is the right location, and that the property is sustainable, that it will remain to be an attractive investment product. So.
Okay, good. It'd be interesting. I'm going to come to the sectors in a moment, but I suppose just just looking at that side in terms of where these opportunities may come from, I mean, Robert and Simon, I guess, you know, if there are like 5-year funds or something that are going to be ending soon, are we likely to see those extended, or will people sell off into what may well be a worse market than they're expecting it to be in, say, 2 years' time? So, I mean, I'm just wondering what will happen to liquidity in the market, in a sense. Is, will investors actually choose to sell, or will they choose to extend funds? What's the position?
I think we're going to have a period of nothing happening for a while. I think, you know, as a person who owns assets, you're not going to sell it. I mean, if Kevin's right and it's 15 to 30% down, you're not going to sell it unless you have to, right? Because all your hard work is dismissed. So you're going to hang on, and you're only going to sell if you have a valuation issue and you have to put more money in, and you don't want to do that, or you've got a loan to repay and you can't do it, and all that sort of stuff. I mean, all the stuff that Justinas has talked about. So I think, you know, what happened last time and the other times that I've been involved when the market's gone down is nothing happens. So I think we're going to have a period of stagnation. There will be deals to be done. I'm very encouraged by what you say, by the way. I think that's really great. And people with equity and don't need debt are going to be the players for a while. And there's going to be some good assets out there to be bought at a good price. I think it's going to be an exciting time, but be patient, because the market's falling at the moment, and if you go too quick, you could make some mistakes. And the skill of an investor is make sure you get that timing right?
Yeah, I tend to agree. I think it will be a low liquidity market for a while. I think where you may see some transactions is perhaps on the logistics side, because a lot of your logistics developers, even in a falling market, have still made enough money that it could still be worth recycling that capital at the moment. And I think, as we were talking about with financing as well, that could lead some assets onto the market as well. But I agree, in general, it will be a low liquidity market until we get some price clearing going on.
Okay, good. Let's pick up on some of the sectors. Kevin, you obviously saw office, retail, residential, logistics, and then residential. Let's start with office. Does anybody have a view on the office sector? I mean, it's interesting that you mentioned there that Poland occupational levels very, very high. So I guess what are people's views on the office sector? Anyone can dive in.
I'll start on that. Look, I think one of the things, I mean, we've talked a lot about the capital markets. We haven't actually talked really much about the occupational market, which in Central Europe, oddly, is quite strong in all sectors, I think, from what I understand. We've got some office assets which are leasing, getting some quite good leasing assets, and logistics assets which are getting a lot of interest too. So oddly, the occupational side in Central Europe is pretty strong, and that means that the fundamentals will be strong. As long as you haven't over-leveraged yourself too much. So I think, coming back to offices, I think it's going to be polarized as it is across all of Europe. You know, there are going to be some good offices and bad offices. You want to buy the good ones, obviously. And as I said, I think there's going to be some great opportunities in that sector in coming forward.
And when you're saying a good offices, is that primarily grade A ESG, or what's your...
that's another challenge. I mean, I'm talking about location, right? Because I think good downtown offices are probably, near the tube station. All the stuff that we've learnt is where you need to be. But also good tenants and diversity of tenants, etc., etc. But I think ESG is an issue which is sweeping across Europe. It's and if you have to make net zero carbon office buildings, that's going to cost huge amounts of money, because you have to do everything. You can't just change the light bulbs. You have to change the insulation and windows and the roof and all that sort of stuff, and it's huge. So I do think that issue is a sort of side issue from Central Europe. It's a pan-world issue when you have to refurbish office buildings, and that's going to come slowly because it's going to cost a lot of money.
Okay, good. Anybody else have a view on the office side?
What is encouraging, we're mainly active in Warsaw for office, and what is encouraging is that the supply picture is finally improving in Warsaw. It's been one of those markets where so much new supply coming onto the market, which has kept rents at such a low level, probably a ludicrously low level for a market that is as productive and as modern an economy as you find in Warsaw. And that's really because there's been far too much supply, oversupply for multiple years now. That is changing. That supply picture is improving. I think that's very encouraging. Look, we've always had a positive long-term outlook on the Warsaw office market. It's probably disappointed a little on the rental growth side. We've probably done well because of the yield over the last 10 years or so. But I think I'm still a big backer of Warsaw office because I think that prime rent, which is probably still in the low 20s, should be far higher than it is today.
Yeah, go ahead, Dorota, and then...
Just to add on the offices, I think on the supply side, we will be facing very soon a huge undersupply effect, especially in Warsaw, where, I mean, for offices, it's relatively easy to predict what will be, the new production for the next 2-3 years, because it's the production process, building permit, etc. And the numbers, the supply for the next 2-3 years, it's, 200,000 square meters around, which is really like nothing. So we see already the pressure on the rent increase. So I think this is actually, also happening in logistics, exactly as you guys said. I mean, the occupier market, the demand is strong. So we see finally, after years, rent increases. There is, of course, a discussion because we have, of course, the challenges of the high energy prices. And from the occupier perspective, it is not only the rent which they are paying, but all costs. So the question is, what will be the total occupational costs? But nevertheless, on the rent increase, we are happening, and this will be happening in the next 2 years. So I think most of the players who are having office buildings today, I mean, they are doing very well in terms of leasing, releasing, etc. I mean, you will always have exceptions with old buildings, poor asset management, etc. But generally, as a rule, it's a pretty strong market today.
Okay, good. I wanted to pick up a little bit on residential, and I know you've got some views on that, Dorota, as well. But Lukasz, I think you've just done a report around the residential side, so it might be good just to get a sense of what you're seeing on the residential PRS, and you can include then senior living or student housing or whichever one's there. But it'd be good to get your sense of where we are with that market.
Thanks a lot. Yeah, we've done a report on PRS, private rented sector, as opposed to like residential to sell to end customers, and we see a strong story there, and we see a new sector developing in the CEE, just as it has developed everywhere else in Europe. Traditionally, people love to own their homes in CEE. But now, with the economy is changing, they are pushed to the rental market. The housing prices have increased dramatically over the years. Prague, Warsaw, Bratislava, they are among the top 5 least affordable cities for domestic buyers in Europe. It's very difficult to buy a home when you are young, you want to start a family. It's getting almost impossible. And now, when all the economic changes, the inflation, the interest rates rising, it's getting even harder. My mortgage on my house is 1.6%. It's my fixation period stops next year. I will probably be facing something like 10%. So this is the reality, and so some people will just not be able to buy homes. They will need to rent. There was a rental sector before. People were buying the apartments and individually were renting them to tenants. Now it's getting more institutionalized, and there are PRS projects being delivered to the market. And what we see now, I'm based in Prague. I see many new projects, PRS projects, every big residential project to build has a PRS element in it at the moment. We see a lot of PRS activity in Poland, a lot of trading. So we see a pattern, a story of people, being pushed to the rental market and developers taking advantage of that. So I think we are in the phase of building up the portfolio that will come, in next couple of years, and to become a new institutional sector for investors.
Okay, good. Interesting to get anybody else's views on the residential side. And Jonas, thanks for your question online there. I'm going to mention this now, and then people can pick up their views on it. But what Jonas wants to know is specifically for Romania, what exit yields are transactions currently done, and what will be the evolution in these exit yields. So be interesting just to think about what that might be. And also in CE, how will demand and supply evolve for the residential and industrial sectors? So let's just finish off the industrial one with, I suppose, how we see demand and supply evolving. We've had a little bit of that there from you, I think, Lukasz, which is interesting. What's your take on that, Dorota? I mean, what are you seeing in terms of the residential side?
But in terms of demand for residential?
Yeah.
The demand for residential is huge. It's really, really huge. Alone in Poland, we are missing more than 3 million units of dwellings in comparison to the European average, just like that, right? The annual production of flats in Poland in good times was close to 200,000. So you do the math just to reach out the 3 million gaps, how many years you need to construct. When I'm saying this gap is actually for both ownership but also for rentals. There is a shift to rentals due to a few factors. One is, of course, high interest rate, and the individual owners, especially mortgage buyers, are not able to either get a loan or cannot afford paying the very high mortgage. The rent is just cheaper in comparison to the mortgage installments. There is also a change in mind, even before the war, before the high interest rate, change in mind, especially in the younger generation, to rent. The rental market, especially in Poland, is not a new thing. There is more than 1 million of units already rented. It's just, the ownership. It's individual owners holding those ownership. It's not institutionalized. So this is more than 1 million in comparison to 50 million. Sounds low in comparison, especially to Germany, where you have 50-50, but it's not a completely new idea. What's new, it's really the institutions which are coming with a new quality, with, the ease of lease, with all the operational stuff. So you, as a tenant, you don't care if something is broken and you have to fix it because you have an institution behind it. It's just easy. On top of all those drivers, you have, of course, the immigration to Poland, and this is and was very strong before the war in Ukraine. Not everybody knows that Poland effectively granted 4 times more job permits to people from outside of the EU before the war. Of course, it was mainly Ukrainians and Belarusians. It was 600,000. On a 40 million country. Germany was 300,000 on 8 million country, so effectively 4 times more. I don't think some people are realizing that. Of course, after war started, I don't need to tell you, 6 million people within 3 weeks came to Poland. Approximately 3 of them, probably more than 3 of them, either returned or went further to the west. Between 2 and 3 million are still staying in Poland. This is a huge demand of people in a 40 million country. Those people have to live somewhere. So the available stock in Poland is dramatically low. Everything is either bought or rented. Yeah? So the demand is really huge.
Just hold it a tiny bit further away, Dorota,
Okay, so it's now too close. Okay. so the demand is really huge, and I think this is a great really opportunity. There are, of course, challenges connected with this. But we are not a Euro country, we are a Polish zloty country. which basically means investing, you have currency challenge. So some of the investors are struggling with the underwritings. The others are not struggling. It's really depending where the investors are invested, because I mean, if you invest in Nordics, you also don't have Europe per se. Yeah? So this is the other argument which we are hearing from some of the investors. I mean, there are challenges, but with the strong fundamentals, a lot of investors are looking into the market, despite all the challenges, right? I'm not saying it's easy. It's easy to underwrite. It's difficult to underwrite today. You have to take a certain view, but if you believe in the fundamentals, it's probably the right time to be.
Okay, good. Quick question come in here from Marius. Thanks very much for that. Maybe for you, Lukasz, because it's a legal one, which is for the PRS and rental market, from the legal perspective, how will the discussed 10% tax from purchase of more than 10 properties within 12 months or increase of the property tax for the big players, how might that affect interest in PRS?
Well, that would be a tax question in Poland, or I'm not sure I can.
Marius, you may need to give us more details.
Yes, please.
It's
please
in
do.
Poland. It's in Poland.
It's in Poland.
It's an idea.
So,
Yeah.
So sorry.
If you
Czech
like,
lawyer,
I can
maybe?
take this
Yes,
one.
please.
Indeed, there was a kind of announcement by Polish government that they will be working on a kind of taxation, exactly tax on buyers or holders or institutions. I think my comment to this is that, first of all, we do not know many details. Secondly, this is not the first announcement. Third, whatever has a monetary effect, it's only a monetary effect. Polish government will never stop activities on residential, because they are also aware of those housing needs. And fourth, I don't know whether those plans will come true and in which format. It's just a plan. And of course, it's not nice to hear about such plans, because I'm sure it scares some of the investors, so there is no doubt. But on the other hand, I think all announcements regarding governmental plans across Europe where you have no details is to some extent scaring. But on the other hand, you have to really look broader. I mean, if you have fundamentals there and a huge need of housing, no government will, kill any activity. It may have a kind of monetary effect, any taxes or anything. I mean, you have to be cautious in doing underwritings. I think this is also one of the reasons why today we don't see actually a lot of transaction in classical forward funding structures, exactly for all those reasons and all the challenges we have. But I think we see a lot of interest to teaming up with developers and building either single projects or portfolios, just building the scale, because if you are construction, you have some construction risk, but on the other hand, you have enough buffer for any monetary effect which may come. But having said that, no details are announced at the moment, so we are also not taking in any details into underwritings, and also most of the investors are not taking any special provision out of this, because it's just one of the idea at the moment.
Okay, good. Thank you for that, Marius. Let's pick up on the logistics side. Dirk, let's start with you. So, in terms of the demand, and also in terms of any trends that you're seeing that may suggest more opportunities coming through.
Yeah, no worries. Shall I start with challenges?
Let's do it that way round. Let's not do opportunities and finish with challenges. Definitely.
Exactly.
Let's do the positive route.
No, let's start with challenges. Indeed, what was mentioned already, it's about construction costs, what you see in every sector. We clearly saw a steep increase of the construction cost, challenging. And you see for our sector as well, which is a challenge for the local teams, the development teams, is around regulatory. Getting the permit done, it all takes much more time and uncertain. We already talked about the supply risks in markets. It's slowing down. It's getting a little bit better, but for me, that's something I'm always aware of in the CE, supply risks in some pockets of markets, not everywhere, but some pockets. Another challenge, what I personally see for some CE markets, is about transparency. Deals are always not that clear. And in terms of leasing deals, you don't always know the full background of the incentive levels, for instance. So you really need to be cautious in some markets, to understand the full details. When you think about all those challenges, and particularly about supply risks and about transparency in the market, that has led in a market like Poland to very low rental rates. Very low rental rates. That's in a way an opportunity as well, but in the last decade we haven't seen a lot of growth in some Polish markets. Today, when you look at the real rents in Poland and you compare that with 2007, I expect that the rents in Poland are 20%, the real rents, so inflation adjusted, are 20% below the 2007 levels. So there is a lot of room to grow because you're coming from a low base, but we have not seen a lot of rental growth in the last years. By the way, 2022 was a very strong year driven by the construction cost increase. So there are some challenges. Now let's move to the better part, the opportunities. I think when you are fairly well funded in CEE, there are a lot of opportunities. Why? Because when you look at the market trends up to, let's say, in the first 3 quarters, development volumes, so new supply really slowed down in many markets. And I think one of the reasons is that some trade developers had some issues with their finance. So there's less space on the market. At the same time, you have a structural trend of lower new supply, which is driven again by land availability and regulatory. So on the supply side, you see that level coming down. At the same time, you see that demand is driven by multiple structural trends, in the market. So demand is still fairly strong, good, positive sentiment, cautious. So you can expect over time a decline of vacancy. And at the same time, what's interesting, so when you look at the operating fundamentals, it's overall strong, but you see some value decline as well, yields widening. And I think that's when you're well funded, a really interesting opportunity to capture that moment in many markets.
Okay, good. Does anybody else have a view on the logistics side while we're on that topic? You're obviously more in favour of offices, Simon. I know that. So.
Not necessarily. To be fair, in CEE market, logistics is one of our tactical calls. I agree with Dirk. You haven't seen that rental growth for a while, but I think the trends toward nearshoring, or whatever word we want to use about it, is coming. We've got exposure to Szczecin, for example, which we were talking about before. Szczecin on the border of Germany. Essentially, it's a Berlin logistics hub. It works perfectly well. As say, labour is affordable and access is very, very good. We're not yet there in the Romanian market, for example, and I think there was a question for you, Dirk, on Romanian exit yields, which I've got no idea about, so I'll definitely defer to you on that one. But I think again, I think you've got some words to say about Schengen on the Romanian market, which is very interesting, and that seems like a market with scale that could well be in the next 5-10 years a very huge growth opportunity in logistics.
Yeah, absolutely. And when I think about, let's say, the maturity or the liquidity of markets, I would put Czech on top. Czech is the most mature market, liquid market, etc. Then you can think about, let's say, Poland, Slovakia markets. Then you're moving, let's say, towards Romania, and then, it's not fair to say at the bottom, but it's the most immature market, developing market is more Romania, Serbia, Bulgaria, Serbia, that kind of markets. Schengen is, and we talked about it during dinner yesterday, I think that's something we as maybe the real estate community are not fully aware of about the potential opportunity it can have. So short introduction, Bulgaria and Romania might enter the Schengen, so the visa-free zone, by the end of this year. It can be vetoed by the Netherlands, but overall there is a reasonable chance that they will join. So what can that mean for the clients, for the users of logistics real estate, is efficiency. When you look now at waiting times at borders for a truck, they can wait 6 to 8 hours. When you look at the report, it was the average waiting time is 50 euros, and it was a 2016 number. So waiting for 8 hours, 50 euros, you just burn cash. So it will be an efficiency for the clients. Overall, when you look at the labor stats, with Poland, Germany, when they joined the European Union, you saw some emigration. It's debatable. They're already part of the European Union. Current labor costs are not that different between, for instance, Hungary and Romania. So you couldn't expect a big move from people from Romania to Hungary, for instance, to work there. That's not a big advantage. What can it be for a sector? And I think it's really interesting to look at the Romanian border markets in the north, for instance. So Timișoara, Arad, because they are really close to Hungary. For the rest, the Romanian road network is quite underdeveloped. So why would you, if you want to benefit of Schengen, be in Bucharest and drive, let's say, 5, 6, 7, 8 hours to the border while you already can be at the border market? So I think quite an opportunity, short-term opportunity there. Over time, there will be an opportunity for the port of Constanța, which is at the sea. I personally see a lot of opportunity as a nearshoring port, because there will be a lot of nearshoring there. But infrastructure in the port in Romania really needs to be further developed. That's really an important one. And the last one, and this is really hard to quantify, and we touched on it already a little bit. I expect it will help Romania and Bulgaria a little bit to become more institutionalized and an established market. When you are part of, it's not a check the box. We are part of Schengen. That idea. How it will play out, nobody really knows, but it will help for sure.
Okay, good. We've only got 5 minutes left. I just wanted to pick up on, briefly, if anybody's got a view on retail, might be interesting. It was interesting to see that actually retail was still quite high in terms of the transaction volumes. Is that more sort of resilient in Poland CEE, or is this mainly a story of food-anchored retail and retail parks rather than shopping centres? Does anybody have a view on that?
Shopping centres have been difficult in the past because of a lot of supply in that market, but more resilient in terms of consumer spend, certainly much faster consumer spending in the CEE markets. What's worked very well for us has been outlets, an immature market within CEE, but we've got 3 outlets in Poland, 1 in Hungary, and they've bounced back very quickly from COVID.
Okay, good. And in terms of locations, maybe, Carolus, let's start with you. So where are you looking in terms of your investment? Is it across the region? Are you looking at, capital cities versus, secondary cities, regional cities? What's part of your strategy?
So we are location agnostic. We chase yield, so we scan the whole European market. We see which deals work for us. We look for strong covenants for real estate that is what we call mission critical to the tenant, that is sticky to the tenant cannot live without, that the one they're looking to commit for long term. Those are the deals that we like, and we go and buy all cash, all equity, so we're not really affected by that cost to some degree. And yeah, we chase yield, scan the whole market. I can't say that, definitely not capital cities or peripheral cities. Just see where the deals are. So we have to see everything.
Okay, good. And so from your point of view, actually as a kind of all equity player that doesn't need the debt side, then actually you're looking at the next 12 months, 24 months as a big buying opportunity?
Harvest season. No, I'm kidding. I think we're probably going to be a bigger player in a lot smaller market, but again, could be wishful thinking. I'm hoping so. I think definitely the volume of deals transacting is slimming down significantly. I mean, honestly, there's almost nothing happening at the moment. There's a lot of discovery, a lot of people bidding. The deals that are closing are the ones from 6 months ago. People that are bidding now, it's very hard to commit to a yield where, the debt is moving so fast and the debt market is moving so fast. So people are almost bidding and with the idea that, I'm going to attach my yield to a swap curve because I don't know what my yield is going to be tomorrow. So there's a lot of that happening, and I think a lot of sellers are pulling deals from the market. But the ones that we see on the market, we're following through, and I think there's going to be some stuff happening probably less before year end and a lot more Q1, Q2 next year, I think. But yeah, I expect to be taking a larger share of a smaller market.
Okay, good. Does anybody have any questions that they want to ask? Yes, go ahead.
My question is on offices. During the COVID era, we had a lot of space being put out there for subletting. So I'm just having a question about actually all of the markets, but especially about Poland and Czech Republic and Hungary. How that space, is that space still out there? Are tenants still putting space there for subletting? How has that developed?
Okay, interesting point. Does anybody want to pick that up?
Yeah, maybe very general. I don't know the number, but most of the sublettings are either still existing or gone, in a sense that the company returned back. I mean, the space returned back to the main tenant. Basically, during COVID or during the last years, most of the companies increased their staff, so they have use the space effectively, right? I mean, of course, you have this hybrid model. You have different way of preparing the office for your employees. So I mean, you don't any longer have the ratio of 9-10 desks per 10 employees. You are probably closer to 6-7 desks per 10 employees. You have to create more common spaces, etc. It's again very much dependent. It's very different in different sectors. I mean, it looks different in IT, where you have much on online, different in other sectors, but the trend stopped, so to say. Yeah.
Okay, great.
The numbers are very generalised, is about 1 to 1.5% of additional, let's say, grey vacancy on top of it. But it hasn't, it peaked and then it's kind of plateaued over, so it hasn't grown dramatically.
Okay, good. Any other questions? I've got a last one, which is where do we see the opportunity? So, if I were wanting to invest, and let's say I might want to do it all equity, or I might want to take some debt off you, Justina. Who knows? But I suppose what's the situation? Where are we seeing the opportunities at the moment? Let's start with you, Dorota, and work our way around.
Okay, so I would definitely go for residential, whatever residential you like. Either it's residential for rent or buying residential developers. I mean, today for rent, but in few years' time it's the again. So you have to look at the broader residential. I would start with Poland, but I would definitely go to other CEE countries, because I mean the housing needs are also huge in other countries as well.
Simon.
I'll be greedy and take 3. Best-in-class office. I'd certainly do that in Warsaw. I would do logistics if I see a bit of repricing, and residential if I can work out how to deal with the hedging.
I know.
Justina.
Yeah, well, the lenders typically follow the activity in the market. So where the activity is, there we are as well. So I think from this perspective, every market segment can be still interesting from our perspective. Just maybe one comment on the residential market. We, as Berlin Hub, we are also intending to start our activities in this part of the market, still with the challenges. So exchange rate risk and the current cost of financing, it's not so easy, but we hope to be there as well very soon.
Okay, good. Doug.
Surprise.
Is it going to be logistics?
Sorry. No, it would be, for me, what I think will be really interesting is about the scale in the market. And about the diversity. So scale to grow with your clients in certain parks. Because, when you think about the land availability, which is only getting worse, when you think about labor, which is scarce and not willing to relocate from one logistics asset to another one 30 kilometers down the road. So you need to expand on, let's say, adjacent to your location. And on top of that, when you then, and I think we are already developed as a market with ESG, but you invest much more in, let's say, the renewables energy because you have the skill. To even think about big installations, share, give back to communities, and think about the social part as well to create that ecosystem within that park. One small example about Romania last week, what I saw is you have doctor services in that park. That the employees of the clients can go to a doctor if there's something going on. And I think those and that's only achievable by skill. So for me, it's skill to grow with clients, to offer that flexibility, and to implement new energy and ESG features.
Okay, interesting. It sounds as though it's actually easier for me to go to possibly an industrial park in Romania to see a doctor then than it is here in London. Lukasz, over to you.
Yeah, a tip from a lawyer for what it's worth. I like the PRS story. I think it's an opportunity in CEE to sell to the people the benefits of the rented sector, more affordable, more services, and the prime rents are 32 euros per square meter in Warsaw and Prague. I think that's really nice numbers. My first choice. Then I think the position of companies like WP Carey on the sale and leaseback oriented investors is very strong. So I would follow them and like.
Great, Robert.
Well, as a value-added opportunistic investor in this region, I'm pretty sector agnostic actually. I think now is the time to wait for that great asset which comes available at a price that you can achieve, and yeah, so it would probably be capital cities. There will be some mispriced risk opportunities out there which people like us can pounce on, but as I said earlier, you've just got to wait for that moment.
Okay, perfect. Carlos.
Well, I personally think things are going to get a lot worse before they're going to get better. I think you have a generation of investors who build their careers in a low interest environment, and they don't realize that this is not a norm. That before the credit crunch, interest rates were at 5% for many years, and that was the norm. And I think, sub 1% interest rates is not the norm. So a lot of people will think, okay, this is a small adjustment, and inflation is going to go down, interest is going to go down. I think that's not really going to happen. Expect rates to go high. So in my view, thinking that things are going to get much worse, you have to be light on your feet, really diligent with your underwriting, and patient. I think keep the cash close to your heart and keep the investment. So I don't think anyone has a crystal ball saying which sector or segment of the country or region will be better. Because, prices bring chaos, but if you're diligent in your underwriting and in your thinking, you can do good things.
Okay, great. Thanks very much. So very interesting, to pick up your views there, particularly in terms of the fundamentals there and that idea of patience being one of the areas that people should look at, but the opportunities will come through and across the sectors. But very interesting as well, that point about Schengen, I think, which I don't think people do, hadn't really, until you mentioned it and I Googled it, it wasn't something